The pound fell toward a 12-month low against the dollar as the Bank of England left interest rates at 0.5%, ahead of next week's inflation report. I'm joined today by Ross Walker from RBS. So Ross, what are you expecting to see from this publication?
Well, I think the key thing will be that the bank's updated forecasts will broadly validate financial market expectations that the first rise in bank rate will come around the middle of next year. We have a forecast for August 2015 for the first hike. So we'll probably see their growth forecasts being trimmed a little. They've been a little bit optimistic on GDP. Probably a slightly lower inflation forecast. Of course, they also have to input into that forecast much lower market interest rates, which will tend to raise inflation. But the overall projection, I think, will show a slightly lower inflation forecast at the 2 to 3 year policy horizon, and that will be the key policy signal, basically saying there's no rush to raise rates, and therefore probably the signal will be, or the market will infer from that, the first hike comes in the second half of 2015.
The bank also left unchanged a stimulus programme of holding £375 billion. Now Ross, what are your views on this?
Yeah, the policy announcement was very much as expected. What the bank has said is that once they begin to raise interest rates, they will probably, the first step will be to stop reinvesting the proceeds of maturing QE bonds. So at the moment they keep topping up that QE stockpile, but once they begin raising rates, they'll cease to do that. So you'll start to see the QE holdings begin to gradually diminish as those bonds mature naturally. The question then is, will they try to accelerate that unwind of QE by actively selling bonds that are not yet maturing? That's still a very open question. They are considering how to deal with that, but I think with the interest rate hike, the first hike being pushed further out, the QE question is less pressing.
UK's services industry cooled far more than expected in October to more than a 1 year low. Ross, what were the main reasons for this?
Well, I think we've seen really over the course of this year quite a marked cooling in the services PMI survey. It was running way above long-run averages early in the year, and we weren't quite seeing that reflected in the official economic statistics. So some of this, I think, is a normalization in the survey from unsustainably high levels earlier in the year. But I think it's also telling us that there is some loss of momentum in the UK economy as we enter the final quarter of the year. Our forecast is for a slowdown in growth next year to just over 2% versus 3% growth in 2014, and I think that survey is reinforcing that. Some of it is reflecting external influences on the UK economy, the euro area slowdown, but some of it I think is more domestic in nature.
And Ross, before I let you go today, let's have a quick look at the performance of the sterling. Now, how far are you expecting the pound to fall against the greenback and the single currency?
Well, in general, our starting point is that we are US dollar bulls. We think the US economy is going to be the best performer among the major economies next year. The US Fed will be the first of the big central banks to raise interest rates. So all of that supports the dollar, both against the euro and sterling. Sterling, we think, will fall against against the dollar, maybe to the low 150s by this time next year. And against the euro, probably only modest gains. I think if we do see the ECB doing full quantitative easing in the early part of next year, that will probably put downward pressure on the euro. So some modest sterling gains versus the euro, but on a trade-weighted basis and against the dollar, a more significant currency depreciation for the pound.
Ross, it was a pleasure having you on the show. Thank you very much for your time. Well, viewers, I'm afraid that's all for today, but do join us again tomorrow as we will be bringing you plenty more economic updates. Goodbye for now.